Congress just passed an 870-page tax bill filled with major changes for retirement savers. I've reviewed every page and distilled it down to the 5 most important changes that you need to know about if you're retired or nearing retirement. I've pulled out a few bonus opportunities tucked inside the legislation as well. So in this video, I'm going to break down each one in simple, clear language. I'm also going to highlight key deadlines since some changes are permanent and effective immediately, while others have specific expiration dates. And to make taking action even easier, I've updated my free 2025 tax planning cheat sheet with all the latest details. But before we get to that, an important note to share with you. This bill is huge, and the IRS is still clarifying some details. What I'm sharing with you today is based on current interpretations, but as always, consult with your trusted advisors before making any moves. Also, when the bill says permanent, remember, nothing in tax law is truly permanent. A change can in fact be made by a future administration and an act of Congress. With that out of the way, let's jump into the 5 changes that have the biggest impact on retirement savers and how to grab my freshly updated tax planning cheat sheet. First up, remember those tax cuts from 2017 that were supposed to expire at the end of this year? Well, they're not expiring anymore. The current lower federal tax brackets that we've all embraced in recent years are now permanent. In addition, the standard deduction amounts just got even better too. Those who are married filing jointly taking the standard deduction this year can deduct $31,500, up from $30,000 in 2024. If you're single, the standard deduction is half that amount, or $15,750. If filing as head of household, your standard deduction this year is $23,625. And if you're 65 or older, you still get the additional standard deduction, although this new bill did not change or increase the amount. Specifically, if you're married filing jointly, you can claim the additional standard deduction of $1,600 per spouse who is age 65 or older as of the end of the year. So $3,200 total if both spouses meet the criteria. For a single filer age 65 or older by year end, the additional standard deduction amount is $2,000. So if you're married and you and your spouse are age 65 or older, you're looking at $34,700 in standard deductions in 2025. And that's not all. There's another new bonus deduction now available as part of the One Big Beautiful Bill that I'll discuss in just a minute. But first, some not so great news. Despite all the talk, Social Security benefits are still taxable at the federal level. The same formula from 40 years ago still applies, meaning up to 85% of your benefits could be taxed depending on your income. And here's the kicker. The income thresholds used in the Social Security taxability formula have not been adjusted for inflation in 4 decades. This creates a sort of hidden or phantom tax that's slowly been increasing in the background for retirees. While Social Security remains federally taxable, the new bill does attempt to make up for this lack of change by introducing a new senior bonus deduction, which is the 3rd big change to share with you. In short, if you're 65 or older by the end of the year, you now get a brand new $6,000 deduction per person. That's $12,000 for married couples who meet the age criteria. And yes, this stacks on top of the other 2 deductions that I already mentioned. Let me break down the math for a married couple, both age 65 or older. Beginning this year, they will get the increased standard deduction of $31,500 that I just discussed. They will also receive the additional standard deduction for people age 65 and older of $3,200. And now they will also get the new senior bonus deduction of $12,000, increasing their total deduction amount to $46,700 in 2025. It gets even better. This new senior bonus deduction can be applied whether you take the standard deduction or itemize your deductions. But here's the catch. It's only available through 2028, i.e. it's not permanent. It also phases out if income exceeds $150,000 for joint filers and $75,000 for single filers. Once you hit $250,000 joint or $175,000 single, it's completely gone. Now, before we move on, if you're trying to keep track of all these tax brackets and deductions and phase-outs, grab my freshly updated 2025 tax planning cheat sheet. It's got all this laid out in easy-to-read tables. The link to download it is right there in the description below. Okay, change number 4. If you live in a high-tax state, this one is huge. The SALT, or state and local tax deduction cap, just jumped from $10,000 to $40,000. As a refresher, this deduction allows taxpayers to lower their federal taxes by deducting some of the money they paid in state and local taxes. But there are conditions. Your modified adjusted gross income must be below $500,000, and it quickly phases out as your income exceeds that threshold. It's also temporary, and it's set to end after 2029. In 2030, it will revert to the $10,000 cap unless a future Congress takes action. For those in high-tax states who've been getting crushed in recent years, this could save you tens of thousands of dollars. So be sure to run the numbers with your trusted advisors ASAP. Okay, change number 5. Unfortunately, if you're on Medicare and you are hoping to finally be able to contribute to an HSA, I've got bad news. Despite being in earlier versions of the bill, this one did not make the final cut. Once you enroll in Medicare, you are still unable to fund an HSA. Even if you're still working, and even if you're still covered by your employer's high-deductible health plan. But there is a workaround. If your spouse is not yet on Medicare, still working, and covered by a high-deductible health plan, they can make a family HSA contribution of $8,550 in 2025. Plus, they can make a $1,000 catch-up to an HSA in their name if they're age 55 or older. Catch-up contributions to an HSA for the Medicare-enrolled spouse are not permitted. Now for those bonus changes that I promised. First, the estate tax exemption. Starting in 2026, it jumps to a flat $15 million per person. This change is now permanent, and the amount will adjust for inflation in each subsequent year. Next, charitable deductions. Historically, charitable contributions were only deductible for those who itemized on their tax return. But starting next year in 2026, a married couple filing jointly can claim a deduction for up to $2,000 of charitable donations, and a single tax filer can claim $1,000. This law is permanent and there are no income phase-outs. However, there will not be any inflation increases, which will reduce the benefit of this welcome change over time. Sticking with charitable giving, if you itemize your deductions, the new bill changed how much of your charitable donations can be itemized. Specifically, starting in 2026, your itemized charitable contributions must exceed 0.5% of your adjusted gross income to become deductible. For example, let's say your adjusted gross income, your AGI, in 2026 is $200,000, and you donate $1,000 to charity. Well, $200,000 times 0.5% is $1,000. So according to this new tax rule, you would not be able to itemize and deduct your $1,000 donation since it does not exceed 0.5% of your adjusted gross income. As another example, let's say you have the same $200,000 of income, but you donate instead $2,000. In that scenario, you would only be able to itemize and deduct $1,000, the amount above 0.5% of your adjusted gross income. Next, car loan interest. From 2025 to 2028, you can deduct up to $10,000 in car loan interest. However, this deduction only applies to new, personal use, non-business cars that are assembled in the U.S., and lease financing is not eligible. This deduction is also subject to a phase-out schedule and is reduced to zero if modified adjusted gross income, or MAGI, reaches $250,000 or more for married couples and $150,000 or more for single filers. Lastly, Trump savings accounts. More clarification is still needed from the IRS here, but in short, these are essentially traditional IRAs for minors. The investments in the account grow tax-deferred, like an IRA, and are taxed as ordinary income when money is withdrawn at age 18 or older. You can contribute up to $5,000 per year beginning July 4th of 2026, and the government will kick in $1,000 per year for kids born between 2025 and 2028. Again, still more to learn, but on the surface, I'm not yet convinced that they are as beneficial as we're led to believe. I know I covered a lot today, and it's a lot to digest, which is why I'm handing out my free tax planning cheat sheet that's been completely updated with all the changes from the One Big Beautiful Bill. It includes all the new deduction amounts and phase-outs in easy-to-read tables, annual limits and important exemption amounts, and key retirement numbers for 2025 planning. Everything that you would need to reference to ensure that your tax plan is buttoned up this year. Just click the link in the description below to grab your copy. It's completely free, no strings attached. And here's my advice. Don't get caught up in the political noise. Focus on the things you can control. Use this cheat sheet along with your trusted advisors to see exactly how these changes impact your specific situation and take advantage of these opportunities while they last. If you don't have any retirement tax experts on your team, or if you're looking for a second opinion, book a call with my team using the link in the description below. We'll analyze the health of your retirement plan and show you the exact tax strategies that can help you avoid overpaying the IRS. I'll see you in the next video.